Chinese bonds are signaling deep skepticism about the country's economic recovery, even as the stock market rallies on hopes of a revival in consumption. Our next report telling you more.
China's bond market is sending a stark signal. Long-term growth prospects remain bleak. The yield on China's 10-year government bond has plunged more than 80 basis points this year, hitting a record low of 1.78%. Meanwhile, 30-year yields have fallen below 2%, even lower than Japan's 2.24%, an economy known for deflation and stagnation. Despite China's stock market rally driven by hopes of consumption revival, bond investors remain unconvinced. The message is clear. This isn't an earnings or reflation-based rally, and the outlook for growth remains subdued. China's $4.6 trillion bond market reflects a deep skepticism about the economy's recovery. While equity markets have rallied since September on policy support and interest rate cuts, bond yields continue to scrape historic lows. Banks holding over 300 trillion yuan in deposits are pouring cash into government bonds due to weak loan demand. This flood of liquidity has pushed yields down. Analysts note that with low inflation and a sluggish property market, there's little resistance to the ongoing bond rally, signaling slow growth ahead. Investors in Chinese bonds are bracing for a subdued 2025. Goldman Sachs predicts the economic growth to slow to 4.5% next year. In contrast, the stock market has surged on hopes of a consumption revival. But bond experts caution that this optimism isn't supported by fundamentals. As banks shy away from risky loans, the safe haven of government bonds continues to attract cash, driving yields lower and highlighting doubts over China's long-term recovery. Business Bureau, WION World is One.